And our next panel is going to be executing the transaction. So those are two panels that we're going to be having, one after another. Once again, remember the raise hand feature that we'll be using for you to ask questions at the end of each panel presentation. Both myself as well as John Milligan, who's in my office, we will be the ones moderating the two panels. And with that, I'm going to make introductions to our first panel. Just after the two panelists discussion, we have Fidelity Investments joining us with their lead economist speaking about the markets and the economy. And we have a special guest after that who's also speaking, another Fidelity who is a senior geopolitical analyst speaking on geopolitical issues around the globe. So excited to have both of them. Then I'll be finalizing with retirement income strategies that business owners need to think about. So specific things that business owners need to think about as they're looking at their exits. So with that, now we are showing you our first panel. Like I said, this is our panel speaking on different avenues to exit. So with that, let me just introduce our panelists. We've got both Dora Lanza as well as Rob Connolly joining us from Plethora businesses, and we are happy to have them as they are M&A advisors, i.e. investment bankers as it were, who help on that sell side of the transaction, and we'll be asking them lots of good questions about M&A advisory. And then we also have Drew Adams, who's the president of Stone Creek Capital, and he also oversees all the day-to-day operations and investment activities for Stone Creek, which is a private equity firm. And Drew is on here. And then we have David Goldenberg. David Goldenberg is founding partner of VLP Law Group, and they help growth-oriented companies on financing, M&A, and general contractual matters. And with that, he is going to be talking about internal transactions and thinking what people need to think about multi-generational planning. And then we also have Pete Prodoehl. He is the vice president of ESOP Consulting and Principal, and he has over 40 years of experience in looking with ESOP specifically for the last 35 years, and he's going to be talking about ESOPs as a possibility as far as exit strategies with that. And then John Milligan in my office. John, can you also join us? John, are you there? There we go. And John Milligan in our office, he's Wealthwise Financial. He is our CFA, Chartered Financial Analyst, as well as the Director of Investment Operations. And he and I will both be moderating this panel. So with that, everybody, thank you for joining us on our panel. And if you'll go ahead and unmute yourself so that we can hear you as we ask you questions, that would be great. And let's see here. I'm going to start the questions here. Let's see here. Give me just a moment. I'll start this question. David, I'm going to start with you, David Goldenberg. So thinking about the who regarding potential buyers in a transition, what are some things to consider with family and internal sales?
Thanks, Lorraine. And I thought it was a very inspiring opening speech that Peter gave. So, and I think that he touched on a lot of the points that I think owners should be considering. You know, there's a lot of it is emotional. You know, when is the time to sell for a lot of my business owners is a personal, very personal decision. For a lot of people, this is their baby, this is their life's work. And so you really have to get to that emotional place of letting go and having a plan for what you're going to do after. Regardless of the type of transition, you know, whether you're selling to a third party or handing it over, you know, to family members or others, employees. I think you do need to, there are some planning items here. There's the things that the lawyers worry about, you know, are your papers in order? And can, you know, if they aren't, that's going to take some time very often to clean up and get going. And also something you'd like to do for a lot of those kind of issues well in advance of the sale. For instance, if you had always promised your number two, 20% of the company or 10% or whatever number that was, and you never got around to doing it, doing that on the eve of a sale is going to be much more difficult than if you gave that a year or two even of advanced planning. The same thing with other types of, how would I call this, deferred maintenance, right? You had some founder that left and you never papered their transition out, or you never bought their stock back. All of those kind of things, again, can create really significant issues if you're trying to do them too close to a sale. So those are some issues, along with all the emotional stuff that Peter mentioned, that I would at least start thinking about early.
And specifically when it comes to internal transactions, what are some good business practices that people need to think about?
Yeah. So, and again, Peter touched on some of these, but the how, right? How is this going to happen? And actually having that second tier of management lined up, capable of taking over, is a big piece. And then the other big how is, how are you going to value the business? How are they going to finance it? All those nuts and bolts details, they're probably things, again, the owner may not have thought through in a detailed fashion, may not understand the financial or tax consequences. And the people on this panel are, all capable of helping them get to those places, but they really need to start thinking about that.
That's great. John, I'll turn it over to you.
Yeah, absolutely. This is a question for Peter on the panel in regard to employee stock ownership plans. And really, we're just looking to know, what does a good candidate look like for starting an ESOP?
Sure, John, thank you. I think there's 7 characteristics that I often talked about, the first 2 of which are a bit subjective, but the first one is, I think the company has to have at least 50 employees in order for it to make. Some of the limitations, legal limitations, are payroll based. So I think if you have 50 employees, those wouldn't be as much of an issue. I sort of draw the line at the minimum transaction value in the $5 million neighborhood. If it's less than that, sometimes the transaction costs can be too significant in relation to the value. The company needs to be profitable, consistently profitable, with strong cash flows, and that's obvious in order to have value, that it has to be profitable. The company should have a culture that's conducive to sharing not only information, but ownership. The company needs to have debt capacity or a willingness on a part of the selling shareholders to finance the transaction. It should be a company that's not looking for the highest offer. For example, a strategic offer. An ESOP can pay fair market value, but they can't pay a premium. And the last characteristic that I think is very key is the company needs to have a history of having funded a retirement plan contribution for its employees. It's hard for me to understand that a company can go from not doing anything in that regard to all of a sudden funding a retirement plan with ownership in the company. So I think if you look at those 7 characteristics, it would give you a good idea as to whether or not your company was a good candidate.
Thank you.
Wonderful. Okay, so Rob and Dora with Plethora, what are some of the key advantages in working with an M&A advisory firm when thinking about selling a business?
Rob, you want to take that?
Yeah. So, when looking at key advantages of working with an M&A advisor, I'd say one would be a higher success rate, really of completing the transaction. Something to just kind of stay on theme here really is when selling your business, a lot of these owners, this is their baby. It's something that they've cultivated over several of years, invested a lot of time and passion into this business. And, like Peter and David mentioned previously, it's a very emotional decision. There's economics that come into play, but it's a very personal decision for these owners. And, one thing that we would encourage and recommend is bringing on the right advisors to make sure that you do it right, that it's done correctly, and you're not in a situation where you're kind of out of your know-how negotiating one-on-one with a buyer, potentially being, I don't want to say taken advantage of, but maybe not getting the best for yourself and the business that you could. With an M&A advisor, we're going to be able to bring options, options that are only really a competitive process and a market process can bring. And by market process, what I mean is with M&A advisor, you're going to be, putting together a deck on your business through a confidential process, but reaching out to a good amount of qualified buyers that have a keen interest in your type of business and pitting them up against each other. And what that will do and what that will deliver to an owner is kind of the insurance that, every stone was looked under, and putting that in front of you to ultimately make a decision on what type of offer and buyer and vision that you feel is right for your business. Whether or not that's going to be a strategic buyer, a buyer in your industry who, may be a competitor, but just, strategically makes a lot of sense as an acquirer, where they're going to be, in most cases, wanting to buy 100% of your business and offer a quicker, exit from the business. Or it might be a financial buyer. Maybe you want to stick around, stay in the business, retain some equity, and kind of be a part of the next, 2 to 5, 7-year growth plan, and look for a second bite of the apple. Only by really putting all those options in front of you, having the chance to communicate with this buyer pool and get a sense of what makes, most sense for your business, are you going to feel comfortable that you made the right decision? And lastly, I would say it's just selling your business is not an easy task. Most processes take 6 to 9 months when you sign up with a firm to have the mandate to sell your business. And it's not easy. It takes a lot of time. It takes a lot of resources. And the last thing that an owner wants to do is take their eye off the ball when they have an asset they're looking to sell for a price. Our job is to reduce that burden as much as possible, mitigate what this process looks like as far as a time commitment on your end, but still make sure that we get the job done.
Right.
And to that, I like to add, Lorraine, that a lot of business owners do not realize that length of time that it takes for this process. And to Peter's point is, the earlier you start planning, the better off you are. It just enhances the probabilities of getting the best value for your company and keeping your eye focused on the success of your business while you're going through the process.
Thank you so much. Okay, John.
Absolutely. So the next question here is for Drew Adams, private equity expert on the different avenues to exit panel. Drew, when should an owner think about private equity versus some other potential routes?
I think leveraging off of what Rob and Dora talked about, and Peter's theme, as well as what David mentioned, it all kind of coalesces around ultimately the seller's goal, right? You own a company, and what really are your goals that you're trying to accomplish? I think Rob mentioned the idea of you could look at a strategic buyer exit or a private equity exit, and they are very, very different things. It's really unusual for us to run across an owner who is indifferent, because the avenues are, almost night and day. So a strategic buyer is going to come in, and they probably don't need you and your senior management team, because one of the reasons they would be interested in acquiring your company is to remove a lot of the overhead costs. So in that situation, your extended team isn't particularly important to you, and you want to be able to maybe be on the beach in 6 months. Where if you're going to be looking at private equity as an option, it's a very confusing market, because you look worldwide, there's databases out there that have 3 million companies in them. There's 300,000 plus investment entities. There's probably 15 to 20,000 private equity firms around the globe. So it's a pretty confusing mess to figure out where am I going to go? How would I do it? But the goal initially has to be, if you fall in the category of relationships are important to me, my people are important, The legacy of my business is important to me. I really believe in the future. And frankly, I'm willing to eat my own cooking. So I do want to roll over some value and retain a meaningful percentage of the company, because over the next 4, 5, 7 years, I could make perhaps half again as much as the company's worth today, maybe even double the value if you have a growth strategy and you really believe in it. And that time period, especially when you're working with private equity, also helps alleviate a lot of the pain and stress of the succession concept that Peter was going through. Because that's one thing that private equity is very good at doing, because almost by definition, they very seldom exit with the same CEO that they acquire. Because if it's especially if it's a family owned or individually owned business, they're selling because they have that longer term plan. They want to work their way out of the business. A lot of these companies are probably too small to actually have 5 people on staff that you could say, hey, they could replace me. But that's also where private equity has the resources and the connections from a global search process to go out and find the proper replacement, and then work on a several year, very explicit, open transition plan. So it's the idea of how do you meet private equity would fall probably back into a Rob and a Dora type organization, because they have relationships with hundreds, if not thousands of private equity investors, which could be either a family office or a private equity fund or a small business investment corporation. They come in a lot of different flavors, which each also have their own implications. If you go with a family office, they might hold on to your business for 10 or 20 years. If you go with a private equity firm, the average hold period is 5 years. So it's just a different, it all falls back to what your long-term goals are yourself.
Great. Okay, I'm going to go back to Rob and Dora. So, many business owners start getting phone calls from potential buyers. And I guess the question is, at what point should a business owner stop taking those phone calls and start speaking to an M&A advisory firm, an investment banking firm? When is the right time for a business owner to really give a call to an investment banking firm?
Well, we always advise, Lorraine, that if you're getting those kinds of calls and you're serious about the process, that you call an M&A advisor right away, an investment banking firm. To get emotionally tied up with a particular buyer can work against you. Many instances, they lose objectivity, the seller loses objectivity, and he's negotiating against himself. Like Rob explained earlier, when you manage a very closely monitored competitive bid process, the business owner wins. So I think when the thought enters your mind that you're serious about selling, if someone calls you and it triggers that idea, I think I'm ready to sell, that's the time that you want to reach out to us.
And I would just add, there's a lot of buyers out there that are contacting owners on just a broad blast, kind of approach. Most buyers that are emailing business owners saying, hey, I'm interested in your company specifically, probably don't even know, what you do. They're just blasting you and fishing and seeing, who's going to pick up the phone, who's going to answer this email. Another reason why I would recommend, getting an M&A advisor is you don't want to waste your time qualifying and vetting these individuals that are contacting you. That's something that we can do, and make sure that if we are going to invest time in a buyer, that, A, they're qualified, and, B, they have the money. They can actually get the deal done, and we don't have ourselves in a situation where we've spent so much time, so much resources for a buyer that never could really pull the trigger in the first place.
And to add to that is you start to release sensitive information from your business, and that can work against you. There are a lot of individuals that are not necessarily very ethical. Let's say you release the name of your top customer. Are you setting yourself up for that customer being poached from you? So we really do encourage business owners to get started with an investment banking firm right away. We know how to manage the process. We know how to control that process. We know how to maintain the confidentiality so that the business owner is in the driver's seat.
Wonderful. John?
Thank you. All right, so this one's going to go back to David Goldenberg. David, this is a question really, what are some of the things or reasons that you've seen that have caused clients to wish that they would have started to work with you earlier in their deal process?
Thanks, John. Yeah. And this happens all the time. I think Peter referred to it's that thing you don't want to get around to doing, or you just don't want to start, or and these are very often we're dealing with things that there's an emotional issue involved. Like I said, that ex-co-founder you never got the release from, he's probably not, he or she is not the person you are excited to call and try to settle some old issue that never really got settled emotionally between you guys. But that's what we need to get done. And there's, the last thing any of the people on this call want is for you to start a process, and you as the owner want, you start a process, you get a term sheet, you get super excited, and then you have to go tell the potential buyer, hey, we need to pause for 2 or 3 months while I clean up my cap table. And, because I need to make sure when we've sold that business that the percentages of the purchase price go to the right people. So that's one big piece. And those things take time. And like I said, can be emotional and sometimes tricky to deal with. The same is true on the reverse, which is if you have people you want to get into the business. I have founders come to me or owners come to me all the time and say, well, I meant to give him 10%, 5 years ago when he started, and that was the deal. Here's this email, I wish I would have bought Apple 10 years ago. I mean, we all have things we wish we would have done. Unfortunately, you need to actually do those things for them to be legally effective. And again, the same thing, trying to get someone 10% of the business, and let's say you wanted it to be the business to be worth, let's say $1 million, when today your business is worth $10 million. The IRS is not going to look kindly on you saying, well, my business instantly went from $1 million in value today to 10 million, 2 weeks from now when I've actually closed the deal with the buyer. So you need to figure those things out sometimes years ideally in advance. And then the last one is, and this probably the financial types on this call can speak to more clearly, but they'll tell you the quality of your earnings is, I think, as important, if not more important than ever. And so when a buyer comes in and you have no idea that it's going to be a concern to them that you have one customer that has 50% of your revenue, or all your customers have signed in the last 3 months, or you have a high amount of churn, those kind of things are things owners may not think about because they're doing well month to month, but just tweaking those things slightly can really make your business present in a much more valuable way. And again, take 6 months, a year to refigure.
Yeah, great point. So Kate, back to you on ESOPs. Can you tell us the process from start to finish so that business owners understand what that would look like if they're interested in an ESOP?
Sure, Lorraine. Just happens to be a 7-step process. It really starts with a preliminary assessment, and in the very preliminary stages, it's a phone call. It's a 15 to 20 minute phone call with a possible ESOP prospect, where I'll ask a series of questions, maybe 5 or 6 or 7 different questions, and they may ask a few questions. And at the end of that phone call, the light's either red or green, and it's a very short process. If the light's red, it means that I heard something or said something that led me or the prospect to believe that it just doesn't make sense. If it's green, it doesn't mean that the company's going to end up with an ESOP. It just means it's worth going to the next intersection. And the next step in the process is to hire a consulting firm to do a feasibility analysis or a financial analysis. And what that involves is putting together the company's projections, at least 5 years, 5 to 10 years, 5-year projections, a 10-year model, a picture of the company's future without an ESOP transaction. And then we'll lay different ESOP transaction structures, maybe a 49% ESOP purchase or 100% ESOP purchase, we'll lay those different ESOP transactions on top of the base case and look at the model to see how it impacts the company, primarily from a cash flow perspective, from a tax perspective, and what it looks like to the selling shareholders, and also importantly, what it looks like to the employees. You know, what does the employee benefit aspect of the transaction look like? And after having gone through that analysis with the company, the shareholders, they will have a good understanding of whether or not they want to move forward. That's really the key decision point, because once they move forward from there, they're pretty much committed to spending some money, some real money. So if they go forward, the next thing to do would be to assemble a team, a transaction team, to make sure they had good ESOP counsel, and more often than not, they'll have to bring in special ESOP counsel to represent the company. They'll hire an independent trustee to negotiate on behalf of the ESOP, and the trustee will have their own financial advisor as well as legal counsel. They'll hire a sell-side advisor if the transaction warrants, and to help them with evaluation and coming up with their asking price, and to help with negotiations. And once the team is in place, there will be a management presentation where the management will present the company, their history, their future projections, their customers, their key employees, their key competitors to the buyer, to the trustee and his advisors. And that will kick off the due diligence process. And the next step would be the combination of just documentation, drafting documents, stock purchase agreements, credit agreements, plan documents, summary plan description, but also the most important part of the process is the negotiation, the back and forth between the sellers and the buyer being the independent trustee. And that process in today's environment, you can expect at least multiple turns of the negotiations before you have an agreement to move forward. And once you have that, the final step is the closing and the flow of funds. And after that, the communication to the participants, and what the ESOP means to them. It's typically from start to finish not too different than what the other panelists mentioned, but it's about a 6 to 9 month process on average.
So really what I'm getting from you is that whether it's going through an investment banker or whether it's going the route of an ESOP per se, it's in a sense almost the same time frame. So time frame's not so much an issue, and it seems like it's more of an issue of what does the business owner really want as far as the way that they would sell their business.
Exactly. I've always said that if somebody wants to, if a business owner wants to be done and not look in the rearview mirror within a 1 to 2 year period, or even a 3 to 4 year period, an ESOP probably doesn't make sense. I think to successfully transition your business using an ESOP, it's more like a 5 to 7 year process. Just because there's financing involved, and it's non-asset based financing, so there has to be some form of collateral or guarantee, and typically that involves the seller, either in the form of a seller note or the seller, personally guaranteeing the bank financing.
Right. So really the same time frame as the private equity side as far as the business owner's commitment to really stay in the business.
Yes.
Approximately right. Okay, John, back to you.
Yes, thank you. So we'll go back to Drew Adams on the private equity side. So previously we discussed about private equity versus other routes. If a business owner is seriously considering private equity, what do they need to know about private equity specifically and the process they're in for?
Let's say they're working with an advisor or working without advisor. The facts that they need to be aware of fall into several different categories. One is going to be the type of a private equity firm they might be interested in working with. And then the second is, if you think about an owner going directly to private equity, let's say they have a club membership and somebody says, hey, my buddy runs a private equity fund. There are lots of owners that will in fact meet that person, start talking to them, and say, hey, would you be interested in my business? I don't particularly think that would be, if I had a friend, I wouldn't advise them to go that particular route, because private equity is filled with people that have funds that they're managing, and they're going to look at 500 to 1,000 transaction opportunities a year, which may seem like a lot, but it actually, for larger firms, some larger private equity firms, those numbers grow well beyond that. And a private equity firm is going to maybe close 1, 2, 3 brand new platforms in any given year. If you take a middle market type funds that focus on the area of the market that Stone Creek does, which is kind of 10 million in EBITDA and below, their volume is huge. So why would that needle in the haystack work if you just happen to meet somebody and they say, yeah, we want to talk to you? What they're telling you, or what they don't tell you, I should say better, is that private equity firms love to have optionality on a company, which means they'll try and tie you up, get an exclusivity period, and then later you'll find out whether they actually were serious about wanting to buy your company or not. So it really puts an owner in a kind of a box of working in a serial fashion, to where that 6 to 9 month time frame that is being alluded to goes out the window, because they invest that amount of time, then find out that this group wasn't actually the one that was going to buy them. So that's a challenge. Now, there's some real positives to private equity as well, because a lot of owner entrepreneurs are very relationship driven. And the idea of having their information go out to dozens and sometimes hundreds of different investor groups and or competitors is just distasteful for them. They don't want to just have somebody show up, meet them in a conference room and say, yeah, that, I like the guy in a meeting. They really want to build a longer term relationship with somebody, which is an opportunity with certain private equity firms, or like Stone Creek, we're an independent sponsor. So we actually are kind of a hybrid almost of an advisory firm and a private equity investment firm. So if they're relationship oriented, then maybe it does make sense for them to work along directly with one group, but it's still a little bit risky. And the one real big positive, going back to the ESOP comment, an owner, oftentimes they have to guarantee any debt that they have at their company while they're the sole owner. That doesn't exist with private equity. Private equity firms do not guarantee loans. They're well collateralized. The lenders obviously have all their rights and liens, et cetera, but there's no personal guarantee, there's no corporate guarantee. And that's something that owners need to be aware of on the really positive side of working with private equity.
Yeah, so it sounds like, really the general counsel or outside counsel, the attorney, M&A attorneys, as well as your M&A advisory firm, investment banking firm, could be the ones that lead a client down the path of which way is the right way for them.
I would agree. It's invaluable to have some sort of advisor. We do run across opportunities where there's no advisor. We get introduced to a business owner, and without having at least a very competent corporate M&A attorney or an accountant who understands, the transaction side of businesses, they're kind of lost. I mean, it really is a challenge for us to work with somebody who doesn't even understand the lingo or the glossary or whatever. So that we're willing to invest that time, but it is a much slower, harder process, because we'll put forth an offer that they don't know how to put in context. It might be a great offer, or they might not think it is, but unless they have either an M&A advisor or an attorney who says, look, I see hundreds of deals a year, and yeah, that's, you ought to be pretty happy with that. Then they're kind of flying a little bit blind.
Right.
I
So
would just add, to Drew's point that, so we've done all kinds, although we don't work on ESOP transactions. I think, as Peter mentioned, that's usually handled by very specific ESOP counsel. But certainly, as between M&A, internal transition, and private equity, I haven't seen Drew's documents, but is typically a very complicated transaction. Both the paperwork itself, and a lot of times they're working to balance the goals of the different constituents in a way that's not the first way you think about it. So, with a lot of times there'll be catch-ups and preferred returns, and, things, as Drew mentioned, are very complicated for a novice to understand. So we definitely, I think a big part of what we see our role as doing is helping provide that sort of, well, this is what that means, kind of counsel to clients. But I think they'll need to get that from somewhere, because, like I said, in particular, private equity is it's not like, I'm going to sell you my business, you give me $100, right? Which is, how a typical M&A transaction might go.
So David, to you, let's go back to you and talk about, everybody likes to hear examples and success stories, as well as maybe some that weren't so successful. So with your practice, can you give us some success stories, maybe with internal transitions, and maybe some that weren't so successful?
Sure. Let's see. I'll try to think of a couple. So, private equity, and again, I don't mean to speak to, I've never worked with any of the people on this particular panel. And I think so much of it, and you'll hear, and I think this is intuitive for business owners, is, you have to deal with people that you know and trust. There's a lot of trust in a lot of these things, or at least the owner will be asked to be taking risks. I've almost never seen an M&A deal where it's all cash that you get to keep with no consequences down the road, right? So there'll be a chance for the buyer to come back and potentially make a claim for something that they found out after closing. Again, that's really trusting that that buyer isn't going to try to harass you with those kind of claims. So it's knowing and trusting that. If your deal has an earnout, that's another very common term, which would mean part of the purchase price is going to be paid to you in year 2 or 3 or 5. Those, again, how that is structured can really determine a lot of the upside that the owner sees, and is something that is really the mindset of the owner. So a lot of times what we help the owner do, for instance, in private equity, a lot of, as Drew mentioned, you kind of get to sell the business again. And how much control you have in that downstream business. Some private equity brings in their own management on day one. And so it could be more of a lottery ticket, as to what happens to your business 5 years from now, because you're going to be out of control. Others will want you to run the business. And then it becomes a sort of joint venture where they're bringing extra skills or new channels, sales channels, or capital to the business for you to grow to the next level. And where you get to trust yourself, maybe you can be more confident in that second bite. Things where it's been difficult is where the seller had an unreasonable expectation on value. So we did a deal that died because the seller's sales were going flat to, they had a nice ramp when the buyer approached them, and then things started looking like this 6 months later. And the seller readjusted the purchase price, the buyer readjusted the purchase price, and the seller thought, well, that was a temporary dip, we're going to go back up. And that's where an advisor can really be handy. When you can get someone, I think as Drew mentioned, that's seen 100 deals or hundreds of deals, they can tell you, this is a good offer for where your sales are right now. You can pause the process, but you're not going to get a better deal from another buyer. Those kinds of things are really helpful. And in this case, the seller didn't have independent advisory. And so they're going on, as someone mentioned, drinking their own Kool-Aid, right? They have this rosy picture of what they think the future is going to bring, and the buyer may not share that. So those are a couple of thoughts, but you can talk all day about war stories. I'm sure we all can.
All right. John?
Yeah, absolutely. So we'll go back to Peter, who just given us an idea of the time frame of implementing an ESOP plan. And we want to know if you could give us a little bit of information on the ballpark cost to implement an ESOP.
It varies, but I think a fairly good rule of thumb is somewhere in the neighborhood of 3% to 5% of the transaction amount. At the smaller end, the $5 million transaction, you're probably looking at something in the 5% range, and as you move up from there, it goes down to nearer to the 3% range. But every transaction's different, John, and that's a pretty good rule of thumb. But there's a lot of things that can cause you to go outside of those ranges.
Great.
Thank you. We appreciate that.
And then Drew, back to you. You talk, tell us a little bit more about the time frame the business owner really needs to be committed to the business if they're thinking about private equity. And also, what happens to that business owner upon that final exit? Can you talk a little bit about what that transition looks like if somebody's going the private equity route?
Two really good questions. So one thing that a business owner needs to realize when they go to sell a business is that they're going to enter into a non-compete, non-solicitation clause that is going to be at least 5 years long. That's actually about, I mean, David would be able to tell us more, but that's about as far as you can legally do it in California. Now, every state's different. There are some states where they might get locked in a little bit longer than that. So let's talk about the timeline and what would be expected. If they are going to roll over equity and be a meaningful owner, let's say they want to own 20% of the company on a go-forward basis, get into your question of what happens during that next exit. Presumably by then, they have been replaced. They're no longer the CEO because you've gone through the succession plan. You've got their replacement. Everybody's excited about that. But they are still a meaningful owner of the company. They'll be signing up for another 5-year non-compete. So, extricating yourself from a business, especially if you think, gee, if I could sell this, I'll go out and start something else in a few years. You're really not able to do that because in order to have value for all of the shareholders at that next exit, the buyer, whoever that is going to say, we're not letting your key people who are owners. Now, if you're a senior person and you don't have ownership, they really can't lock you up legally. But if you have ownership, you're going to be stuck in another non-compete for 5 years. So you need to think about that in terms of life planning. So if you're 40 years old and thinking about exiting versus 70, really, really big difference in terms of the impact that might have on what you'll be able to do with your career on a go-forward basis.
Yeah, and it seems like the private equity route is somebody who, like we said, still has a lot of energy left, wants to be involved in the company for a longer period of time. So that would lend itself to someone who's, on the younger side versus maybe the older side, but of course it can vary.
It would, and we work with all types. We're working on a transaction right now where the two owners are in their 40s. They're very excited about the future of the business. They're going to own at least a quarter of the company on a go forward basis. It would be if they both got hit by a truck, even though I agree with Peter's indispensable man comment, it would still be really disruptive. I mean, it'd be very, very challenging for us if that were to happen. But they have a longer term vision of what they want to accomplish with the business and realize they don't have all the tools in the toolbox they need to be able to achieve that, which is why they're interested in talking to private equity. So their timeline, we don't actually expect to have them go through a succession plan over our hold period. We would really intend on acquiring them as the leadership group and then selling them as the leadership group when we go to exit, because they'd be at a point at that juncture where then they might be both financially and where they are in their life, saying, okay, maybe I only want to do it for another 5 years. We also go into transactions where an owner says, I am really looking to head to the beach, in 2 years or 6 months. And the shorter that time period is, and the more reliant the business is on that individual, it's a discount. You simply can't pay the same amount for it because, again, if they haven't followed Peter's book and understood what their own succession plan is, to say, hey, I've got 2 people in this company, either one of whom could take it over tomorrow if I got hit by a truck, your value is going to go way up, especially if you've done the other planning things that David was alluding to, both legally and financially, and got your house in order before you go out to market.
Great. John, I think we have one more question.
Yeah, so we have a question for Dora and Rob, and that is, what do you do specifically to market a client's business?
Rob, go ahead.
So, just to describe our marketing process in general, the way that we go about our marketing process involves, a couple of steps. One would be the initial outreach, and this is going to be done through a 1-page kind of teaser on your company. We'll work with you to put together the marketing materials and represent your company in the best light. But to attract that initial interest from both our immediate network and also, diligent research on our end to identify, maybe some buyers that aren't in our immediate network, but we think would make a lot of sense for your business. We'll contact them with a confidential, blind, general teaser to just kind of get a sense of whether or not the business makes sense for them as an acquisition target. Very high level, very general, put together in a way that you would not be able to identify that this business is your business. At that point, assuming there is confirmed interest, we would get the legal docs in order, the NDA, to make sure that the ensuing sharing of information is done in a confidential and protected way. The next document that we would share with the party once the legal docs are in order and we've confirmed they're a qualified buyer, someone that warrants us sharing this next level of information, would be what we call the CIM, the Confidential Information Memorandum. Now, this is a 30 to 40 page kind of executive summary on your business, where we highlight where the business has been, where it is now, and where you're going. And really highlighting the where you're going part. Because ultimately, what is the buyer going to be purchasing? They're not buying your past. It is important, but they're buying your future. And that's a narrative and a story that we really work with our clients to tailor to make sure that we're highlighting your business in the best possible light, to ultimately, deliver the best value to you and paint, the best story for the buyer as well. But in a way that, is obviously achievable for the business. At that point, the buyer probably has a good amount of information about your business, enough to assess whether or not there's continued interest in the business. And that's where we get into formulating, initial interest letters and offers to determine if it makes sense for us to continue more formal discussions with the buyer. But that kind of highlights, I'd say, the initial marketing process of what you would expect with an M&A advisor.
Thank you.
Thank you so much for that. So with that, April and Carissa are going to field raising anybody who wants to raise their hand and ask a question. And I'm just going to review who we have here on our panel with David Goldenberg, who is an M&A counsel. We have Dora, Lanza, and Rob Connolly, who are the investment bankers, otherwise known as M&A advisory firm. We have Drew Adams with private equity. He's with Stone Creek, that's his company. And we have Pete Prodoehl, who is with Principal and representing the idea of an ESOP. And back to Dora and Rob, their company is Plethora. So part of our follow-up that we're going to have is we're going to ask you tomorrow if there's anybody that you want to talk to further, and we'll be getting those names over to the panelists if you're interested in talking to them one-on-one. With that, Carissa and April, do we have any questions from the audience, from our attendees?
Not yet.
Okay, we'll wait a few moments just to see if there is anyone else with questions. And any final thoughts from any of our panelists here on anything that, any other items that you wanted to touch on in your respective fields?
Go ahead.
Go ahead. Okay, I'll just make a few comments. One of the things that we didn't talk about today was some of the tax benefits associated with selling to an ESOP. In the case of a C corporation, if a shareholder sells to the ESOP and the ESOP owns at least 30% of the company after the transaction, then the seller is eligible to defer the gain on the sale, as long as they reinvest in what's called qualified replacement securities, which is basically any domestic operating company. In the case of an S corporation, an S corporation that adopts an ESOP, the tax benefit is almost too good to be true. But whatever portion of the company that the ESOP owns operates tax-free. So we see a lot of 100% ESOP-owned S corporations out there today, and they're able to operate in a tax-free environment, and that can really help the company repay debt faster and get value to employees faster.
And with that, you had given us some numbers. How many ESOPs are there, and how many does Principal run?
There's
some of those.
There's about 7,000 ESOPs in the United States, maybe 7,500 based on the NCEO, National Center for Employee Ownership. And research that they've done, we have about 1,100 of those that we provide ongoing record keeping services for.
Great, thank you. Dora, you had something else to say.
Yeah, I think I want to just reiterate the importance of starting early in the process for those of our audiences. Really, there's no right time. Like Peter said, start earlier, start with an end in mind. Start developing and investing in your teams, your management team. That layer of management is who's going to help you sell your business. It's not about just you being indispensable. It's also about what the business will continue to do when you're not in it. Talk to your CPA. It's not about that number that you're getting, but what you get to keep. So look at your books and records, look at your financials. You need to make an investment in getting your financials reviewed. Maybe depending on the size of your business, you want to consider the investment in audited financials. All of the things that really clean up your business will translate to a higher multiple when you go to the market.
Great points, absolutely. It looks like we have a question from Henrique. Henrique, do you have a question?
Oh, I don't know. Can you hear me?
Yes, we can hear you.
Okay. My wife and I run a medical clinic, family practice. And at this point in time, you know, I imagine most small practices have had a setback. What is the climate like to sell a practice? Is it feasible? Is it a good time, or what is the present thought?
So Dora, do you want to address the concept of where the market is looking at things, or Rob?
Sure. Rob, go ahead.
Sure. You know, without, I guess, having a firm handle on what, you know, specifically the impact has been to your business, I would say, just on a broader concept, that there is still, you know, actively interest in acquiring companies, even in today's climate. You know, we are still closing on transactions. You know, I think just a couple of weeks ago, you know, we closed on a transaction. However, there is a reluctance to acquire companies that currently, you know, were severely impacted by COVID. I mean, that's just a reality that I think is in the market today, from not only the buyer's risk appetite, but in a lot of cases, the lender's risk appetite. So until the business has stabilized and we have a run rate that has, you know, gotten over the impact that COVID presented to a business, I think it's going to be a challenging climate for business to exit until there's that stability that is renewed to the business.
I think that's a great point. David, do you have anything else to add, David Goldenberg, on what you're seeing out there?
Yeah, just two parts. Sure, on in terms of timing, I think Rob is exactly right. So if you have a COVID story, those deals are happening, and those companies are in demand. And if you don't, I think it's a very challenging environment. People just aren't paying attention. You know, I have clients whose business is solid in the overall economy. You know, IT security is certainly something that's on the forefront of everyone's mind, but other types of security, physical security, which was super important, you know, a year ago, not so much anymore. And so things like that, I would say, you know, my guess is that medical related businesses, again, if you have a direct to consumer concept, you know, people's interest in healthcare is high right now. And certainly people's need for doctors and hospitals and medical care is not going to go away. And, you know, the question is, if people aren't getting, like if you did nose jobs or something where it's, you know, surgeries that aren't happening, and your business is, you know, gotten cut in half, you know, think about, can I hold, or what's my plan, or can I pivot? You know, we've had clients that pivot to, you know, COVID testing and are, you know, blowing the doors off of things and opening in 10 new cities and, you know, those kind of things. So again, it's really, what was your response? And then you'll need a few.
Oops. Okay, I think David's audio is going. It looks like we have another question. Tyler, do you have a question?
Yeah, I do. Hi there. I missed the very beginning, so forgive me if you sort of covered this already. But my question is regarding valuations, specifically for businesses that maybe don't show a standard formula of revenue, maybe for businesses that have a lot of customers and maybe a lot of email addresses or something that's interesting to a buyer, a lot of data, but they don't have a traditional revenue to show, you know, a standard multiplier that you could calculate a valuation from. Maybe it's an app that's free or a software as a service company that's free. How are those companies, how is their value calculated? I imagine it's a bit more complicated, and is the approach to sell a company like that a little different?
So let me just address that we're going to have a valuations expert on our next panel who can address that very specifically in a valuation standpoint. However, we might have some people on this panel that could also address that as well. So Dora, did you want to tackle that question?
Yeah, I mean, I could take a stab at it.
Okay.
You know, I guess real quick, if they can still kind of follow up. I mean, is this business making money, or is it purely just a business that has, you're kind of selling a book of potential customers?
I would say more the latter in my hypothetical scenario. Yeah, that basically they have a lot of customers but they haven't monetized it yet, potentially, because their business model hasn't allowed that yet. For example, is that company still sellable, and how would its value be calculated?
Yeah, you know, in the traditional sense, you know, it's going to be very difficult to value this business. The reason being is, to one individual, one investor, you know, this business might be worth $0. You know, there's just nothing that they can do with this asset, you know, this kind of book of customers that you're selling. To another, you know, buyer that maybe, you know, has a strategic kind of value that they bring and can monetize this book of customers that clearly whoever owns them right now isn't able to monetize it. You know, they're able to get, you know, value out of that. I'm sure they're going to have their own approaches to, okay, what kind of return can we get from this book of customers using, you know, whatever we bring to the table. And, you know, they'll be able to reverse engineer value to this book of customers that you're selling in that way. But from a traditional sense of, you know, you go to an M&A firm and say, hey, can you guys value, you know, this list of customers? I think it'll be a difficult and almost arbitrary type approach. But you know, I look forward to hearing what the valuations expert
Exactly.
has to say.
We'll also ask our expert. We're going to have to move on to the next panel right now. But what we'll do is we'll make sure your questions get answered in following up with an email, and any specific questions you have for any of our panelists will be answered. So with that, I want to thank our panel so much for this information. And April and Chris, if you will help us transition